Hi everyone, so we're going to have a look here at the sample paper for BTEC Level 3 Business or Enterprise and the Unit 3 Personal and Business Finance Unit. Now this sample paper is applicable for June 2020 onwards, okay, so if you're watching this prior to then, your exam will be slightly different and we'll run through how that will differ on here, but for everyone else taking this after June 2020, this will be the structure of your paper. Right, let's dig into this then. So I'm going to run through these questions and just put down the answers so you can pause this as we go through. So first up, give two features of a premium current account. So for instance, we could have that you've got to pay a monthly fee. Okay, that takes care of 1 point there. That's jolly nice. We might have something along the lines of travel insurance. It might be free cinema tickets. It might be anything along those lines. Okay, there's the possibility of breakdown cover and all sorts of other things, okay, whether it's phone insurance and so on, all right? So nice and straightforward. Let's move it on. Now we've got describe the role of the Financial Ombudsman Service. So this is an independent assessor, okay, so we could put that down, acts as an independent assessor, and they will deal with any sort of complaints that actually arise that cannot be sorted out by the firm and the customer between themselves, okay. So we've got acts as independent assessor, and they deal with complaints between consumers and financial service providers. Okay, financial service providers. All right, lovely, and that will take care of those 2 marks there. Right, okay, so now explain one advantage to the consumer of using prepaid cards when on holiday. Another 2 marks here for this question 3. So it could allow you to really control your spending because you're uploading your payment onto that platform and then you've only got a set amount, okay, so allows you to budget or control spending. Right, that's 1 mark. Now we've got to explain that now, okay, so what could we add on to that? As the money is uploaded onto the card, is prepaid onto the card, and it also means that if you don't spend all of that money, sorry, that doesn't make sense there, I'm talking at the same time. Right, so yeah, control spending as the money is uploaded onto the prepaid card and you can get that money returned if you don't spend it all, okay, so it means that there's an option there, okay, so that might be advantageous, sets that budget out, okay, nice and straightforward hopefully there. Okay, so let's move it on. Explain 2 advantages to the investor of purchasing shares in a business. Right, so notice we've got 4 marks here, so that requires us really to make sure that each of the 2 points that we identify, we then explain those points further, okay, so we could focus on the fact that there is the prospect of capital growth here, okay, so the share price may rise, right, so share price may rise, and that's lovely, okay, so this will increase investment. Okay, so this will increase investment some. All right, nice one. And we could also focus on the fact that there's limited liability with this, okay, so that means that personal possessions are not at risk, okay, so if you buy shares in Tesco or something like that, you know, the amount that you can lose is limited to the amount you paid for the shares. Okay, so personal possessions are not at risk. Now, if you set up your own business as a sole trader, however, of course, there is that unlimited liability. Okay, so personal possessions are not at risk. Now, you can only lose up to the sum invested. All right, lovely stuff. Okay, that's grand. So let's move it on. Next one, we've got household debt is at its highest level. Right, so in a decade, many families are struggling to pay back money they have borrowed. Shikemi has recently taken out a loan for a new car, but is worried that she might not be able to keep up with the payments. Okay, right. So there's a number of issues here. Okay, and really we want to, on these 6-mark questions, focus on a point. Explain style format, and we've got to include a bit of application here, okay? And that is that she's taken out a loan for a new car, but is worried that she might not be able to keep up with the repayments, okay? So there are a number of issues here. So the structure we're looking at is paragraph 1, really, paragraph 2, and within that we want to give a point and then explain each of those concepts. And good structure to use with each of these 2 paragraphs is this is because, this leads to, therefore, but try and include some application there, even though it's somewhat limited. So what could we identify as a possible point here? Well, point 1 could be that she will she has taken out a loan and will need to make interest payments. Okay, so we're identifying nice and easily there that there's interest payments payable. Now, what does that then lead to? Well, this means then that she's got to pay back more than she's actually taken out. So this means she will need to pay back more than the amount borrowed. All right, that's good. Okay, now the repayments may therefore be high. All right, so the repayments may actually therefore be high. This could lead to stress. Okay, so we've got a high level of repayments. She's concerned about that level of repayments there. Now, inability to make these payments. So inability to make these payments will affect her credit score or her credit rating. All right, nice. And what we could also then extend that onto is actually looking at bankruptcy. Now, I've actually gone beyond this sort of structure here, and I am developing that point quite significantly. I mean, something else I'd then be able to actually say is the car loan could actually exceed the value of the car, because the car will depreciate in value, of course. Now, there's also another adverse impact of this point here, and that is that she might not be able to borrow easily again in the future from other providers. So and that may mean that when she can access finance, she has to pay a much higher rate. So, there's a number of points that we could extend that through to. All right, so let's move it through now. We've got a 12-mark question. So what we can see is a big difference in this paper now between this one and the old format is that it's dropped the 10-mark question here, okay? So it's dropped the 10-mark question. So Nick has asked for advice on opening a current account. He's gained a place at uni. It's 100 miles away. So it will need to live in university accommodation. Currently works part-time, so he works part-time, that's useful, and has managed to save over £2,000. His student loan, and these savings will be used to pay his accommodation costs. Alright, so he needs somewhere for his student loan to go in as well. Nick has been able to transfer his job. Okay, so he's anticipating that he's going to keep getting some income, but won't be able to start work until December. He's concerned about the costs of starting uni, such as rent, okay, and textbooks, and realises that he may need to borrow money until his job starts. He likes to socialise, not keen on cooking, okay, not keen on cooking. Right, so what do we see here? Let's have a little bit of a run through. Well, we can see this one's got an interest-free overdraft. There's no credit interest. There's no interest on that £2,000 he saved up here. Here, there's 2% up to £1,000, so it means that he gets a little bit of interest on there. There's an interest-free overdraft, which is only up to there, though, okay? The additional overdraft fee, yeah, not nice, okay? What else have we got? Unauthorised overdrafts. This is where you've just got to agree it in advance. There's a £60 Amazon voucher, £70 off Kindle Fire. Well, the Kindle Fire might work when it comes to textbooks, perhaps, and you might be able to get textbooks cheaper on a Kindle than otherwise. So that could possibly be an option. What have we got with NatWest? So overdraft's okay. Taste card. Well, this one's obviously going to work here because he doesn't like cooking. This free rail card here is going to work for this this element here that he lives 100 miles away. So when it comes to actually structuring your answer now, we literally want to start off by explaining quickly what a current account is, that it allows regular payments into and out of the account, and then we can run through some of the key points related to each of these areas here. I mean, like, just looking at this, I quite like this Santander option. He's also got the prospect of getting 3% on his £2,000 there that he's actually currently got, and then there is an overdraft, which, while it's not £3,000, it's still and it's interest free up to £2,000. So this looks fairly positive. I mean, I would be thinking later in the question, my judgment would probably be looking at that one as my favourite. So what sort of structure do we want to do here? Well, we've got 12 marks to actually get here. So we literally want to take this through by explaining paragraph 1, paragraph 2 on a second bank, and we can look at each of these two different options here. And we've got to include application through this. Do a third account, but I wouldn't worry about the fourth one. So which one don't I like so much? Well, it's probably on balance this one. I don't like this one so much. So free NUS extra discount card. I don't know much about that. I don't know how good that is. So I would probably discount this one because I know that I've got plenty to write about when it comes to these three. And then I would reach an overall judgment, okay? So I would go through firstly, and I'd do it in order. HSBC is paragraph 1, and I'd explain the good points and how that relates to his situation, downside being that there's no credit interest. Paragraph 2, I'd look at this one, that he gets a taste card, he doesn't like cooking. Okay, so yeah, alright, fine. Then the Santander, he gets 3% on his £2,000. He's also going to have free rail card there as well, and he lives 100 miles away. Okay, so that takes care of that fairly nicely. Now, when you're structuring your judgment, good way to think about actually doing this is you want to answer the question, say what it depends upon, and most importantly, okay, so for this chap, Nick, we've got to be aware that he's going to be getting income coming in, but he's also got £2,000 here. He really needs to get this current account sorted so that he can have his student loan paid in. And he's got to make all his rental and accommodation costs, as well as textbooks and so on. Okay, so what does it depend upon? Well, what's most important to him? Is it, say, having a taste card, or is it having a 4-year rail card? Which seems better? Which is more appetizing? Which is more appropriate? And then, of course, we've got this one. So it really does depend upon how much sort of savings he could get on the textbooks by buying them on the Kindle Fire. All right, so that works really nicely. What's most important do you think as well with that final point? All right, lovely stuff. So let's move it into B. Now, give 2 types of intangible non-current assets. Right, so let's now focus on that. Well, it could be something like goodwill. So this is about brand loyalty, it's about the reputation, it's about how people feel about the actual brand. It could be about patents or patents, it could be about trademarks, it could be about other brand names that a business owns. Okay, so those are all good examples. All right, lovely. Identify 2 causes for a change in capital for a sole trader. Right, so now 2 causes for a change in capital for a sole trader. Well, it could really be the fact that a sole trader might want to have a capital injection come through so that they actually inject some further cash into the business. So that might be one reason. Another reason, on the flip side of this, the owner actually putting more money into it, could be that they actually decide to draw money out of the business. Okay, so drawings would be another example. But then, of course, there's also things like profit and loss. Right, so let's move it on now to question 9 then. Right, so question 9, let's just get it into the picture here. So with this question, the wording is fairly tricky actually. Describe how capital expenditure is treated in the financial statements of a business. So the first thing to focus on, we've got 2 marks for this, okay, is that when it comes to capital expenditure, this is about buying non-current assets, okay? So this is about buying non-current assets, i.e. land, buildings, machinery, vehicles, anything along those lines. It could also be about buying other businesses, so brands, goodwill and so on. All right, so anything that will appear on the balance sheet or statement of financial position. So if you firstly identify that capital expenditure will be spending on non-current assets, and then it will be on the statement of financial position. Okay, that's good stuff. Now, something else we could focus on there, if you're dealing with, say, a vehicle, then you could focus on the depreciation. Now, where does depreciation where does that feature on our financial statements? Well, of course, that's on the statement of comprehensive income or the income statement. So that will then take care of this question. Okay, so not nice wording, that one, but there we go. We can see how capital expenditure is reflected on the balance sheet and income statement. Right, so next up we got Ty, who runs a business which sells a magazine. He's worked out the following figures for the month he's going to sell. He estimates they can sell 20,000 magazines a month with a selling price of £3.50 each. He expects the business fixed cost to be £5,000, okay, annual rent to be £6,000, so we can see his fixed costs at 11,000 there. Raw materials and staff wages would be 30,000. Right, okay, fine. So calculate the expected markup ratio. So a nice easy point to actually focus on here is just by starting off writing down the actual formula. If you write down the formula and you're unable to do the rest of the working, you'll still pick up a mark. So do make sure that you put that down and then try and highlight the working that you're using. So when it comes to actually answering this, then we've got to put our gross profit down. and we've then got to divide that by our cost of sales, and we've then got to multiply that through by 100 there. So let's just work out what our gross profit is here. So when it comes to the gross profit, we can see it's selling and working out our gross profit equals £3.50 minus, so we can see it's 20,000 magazines, and it's costing the magazines, what, 30,000 there, okay? So in terms of the actual raw materials. So as such, 30,000 into 20,000, well, that works out at £1.50. So therefore, we've got £3.50 minus that £1.50 would be our sort of gross profit, okay? So that would give us £2. So when we multiply that through for the duration here, so we've got 20,000, £2 times that 20,000 is going to result in a overall gross profit of 40,000 pounds. Okay, so that's that first bit done. So we've then got to actually put down the cost of sales. Okay, so we can see the cost of sales is basically 30,000. Okay, that's all it's given us for the whole year. So we've just got to use those figures there. So 40 divided by 30 and then multiplied by 100. Well, what does that give us? That ends up giving us what, 133.33%. Okay, so all right, great stuff. You can see where I've put that in there. Right, guys, now there's clearly a mistake in this, and I was a little bit curious about it earlier, but we can really see it here. You know, this 20,000 magazines a month, okay? Now, I reckon this should be a year, okay? So we're just going to interpret that as a year, okay? Because otherwise it just doesn't make sense just giving all of these other figures as annual amounts, okay? So let's just consider that for the whole year. So just using this calculation, you may just want to give this a go to see if you can work out what the profit for the year is. Divide that by the overall revenue there, okay? Right, so let's run through that then. So we know, firstly, when it comes to the profit for the year, that we'd already worked out that it was a gross profit. The gross profit was 40,000, okay, and then we had these other fixed costs to consider there, okay, so there was 5,000 and 6,000. So if we simply then deduct those other fixed costs of 11,000, that of course gives us a gross profit of, a net profit of 29,000, okay, so 29,000. Now we need to establish exactly what the revenue will be. So again, taking this as 20,000 magazines a year rather than a month, okay, what do we need to do? Well, we need to go 20,000 times £3.50, of course, okay. So as we put 20,000 through and multiply that by £3.50, what do we get from there? Well, we get a nice 70 grand figure, okay, so 70 grand comes out of that. All right, now then we've just got to do our overall calculation, and we've then got to multiply that by 100, and overall we should be left with a percentage. Okay, well, it's got a question pound sign there, I don't know, okay, which breaks down like so, okay, so 41.43%, okay, so yeah, nice. Right, so they tried to throw us off the scent there, okay, but they failed, didn't they? Right, now let's move it on then. So we're on to 10C now. Calculate the expected margin of safety for the year. Right, so now we've got to work out this margin of safety. Now remember, when it comes to anything like this, put down how this is calculated to start with. So we've got the actual output minus the break-even point output. So what we can determine here is that he's saying he's going to sell 20,000 magazines. Now we need to establish what the break-even point is. So we know the actual output is going to be 20,000, okay? So minus what is the break-even? Now of course, this break-even point equals fixed cost divided by the price minus the variable cost. So we've already actually calculated some of these amounts. Okay, we had worked out our fixed costs here, annual rent, and other fixed costs here. So that's 11,000. Okay, so we can see that we're going to have, and I'm now doing this calculation down here, 11,000 on the top. We know the price is £3.50, okay, minus the actual individual variable cost, which was 30,000 divided by 20,000, which is £1.50. Okay, now let me just show you where I've got that from. Remember that the costs were 30,000 and he's expecting to make 20,000, so 30,000 divided by 20,000 equals £1.50. So 11,000 divided by 2, what does that then leave us? Well, we can see that we get a break-even point of which comes out at, let's just run through that quickly, excuse me, 11,000 divided by 2, oh well, of course it's nice and straightforward, isn't it, 5,500. I'm not thinking on my feet quick enough there, but not to worry. Now we know that we've got this actual output, so now we can put that figure in, 5,500, and this will tell us our answer now. Okay, so actual output minus break-even point, and that is our margin of safety, which of course will be 14,500 units. Okay, right, lovely stuff. Now again, they've got that pound sign. They shouldn't have that pound sign, but anyway, fine. Now discuss how useful, so we're off those numerical questions now, discuss how useful knowing the margin of safety will be to Ty in running his business. Now, what I really suggest you do is that you use this information that you've already got here in helping you to actually answer this question. It gives you nice straightforward application that you can incorporate here. So we know that this margin of safety is 14,500. Okay, we know that his break-even point is 5,500. Okay, so that works very nicely, and yeah, we can certainly include all of that information there. Now, it could be that we could also work out the profit, the overall net profit for the year. Well, we've already done that actually, haven't we? We worked that out as what, 29,000. Okay, so we could also incorporate that. Okay, that he knows he's anticipated to make £29,000. So given that you've done all of these calculations from these previous questions, like, try and use that information in your responses here. So what he knows firstly is that his sales can fall by a long way here. Now this is a 6-mark question, so therefore we're looking at 2 paragraphs. Okay, so a PP approach. Okay, you give a point, then you say this is because this leads to therefore, and then you give a second point, this is because this leads to therefore, but try and include some of that application as we've said there. Okay, so you know, the first thing we can start off by saying is he knows he needs to sell 14,500 units. Sorry, he has a margin of safety of 14,500 units. So what does that then tell him? Well, how safe does this business look given its break-even point is 5,500? You know, it looks as though he's doing a good job in terms of running this well here. So we can focus on the positives for this, and we know that his sales can actually fall by that much before he's actually sort of threatened by making any loss. Okay, so knows how much sales can fall. Okay, well above break-even point, and that's good stuff. Now it could also be that yeah, he might actually want to make some adjustments to selling price, or even try and further his negotiations. Like, you know, if he's going to be buying all these raw materials, then there's a chance that he could actually negotiate better prices, and he could use his margin of safety. If his margin of safety was low, he'd then be able to say, look, you know, otherwise I'm going to go out of business or something like that. Right, so these sorts of points will take care of that. Okay, now we could also focus on any sort of marketing that he wants to do to increase that margin of safety further. But let's have a look at, so these are very much positive points. Some negative points we could add in there, that ultimately this is all costs are current. Okay, all costs and his prices are current. Okay, and these could change. Okay, so these could change. Now that would then influence the margin of safety and the break-even point. So for instance, if he had to reduce his prices or if costs rose, then that's going to be bad news there, of course. Okay. Now it doesn't consider any external factors. There's no external factors being considered here. Okay, so external factors not considered. All right, nice one. And you could then add in something about competition or inflation. Okay, so prices rising and how that would change his margin of safety. So it's only a forecast really, but it is helpful to know. Okay, fine. All right, let's move it through then. Now, so what have we got here? Connor has recently taken over the family cheese making business, Classic Cheese, after his mum decided to retire. So we've got a different case study here now. The business has been very successful recently, has been featured on several real food programs. Okay, lovely. All right, now what have we got to do? We've got to calculate the inventory turnover. Okay, so again, just go through the processes of writing down how to actually do this. That guarantees you a mark, so just make sure you learn these formulas. Okay, average stock divided by our cost of sales times by 365. Okay, so that is for the number of days, of course, because we want to see how quickly that's actually occurring there. Okay, all right, now so we've then got to actually find our average stock. Now how do we get our average, because it doesn't give us an average stock figure? Okay, well, we've got to take the stock on any given day, and remember the balance sheet highlights the stock on any given day. Now the purchases will take place over the course of 12 months, but these are 2 different days, one at the beginning of the year, one at the end of the year, and what we can do is just add those 2 together and take a average then. Okay, so if we just add those 2 together, so you're literally going, what, 36,325 plus the 49,105 there. Okay, and then we divide that by 2. Okay, so let's add those 2 together, and what do we get from that? Well, we get like 42,715. So that tells us our figure there. Okay, sorry, that was just out of shot. So that is our average stock, because it's the average of adding these 2 points here together. Okay, and dividing by 2. Alright, so that's our average stock position. Now we've then got to establish what our cost of sales position is. Okay, so now how are we going to do that? Well, we can see that we've got purchases here, which is 348,973. Okay, fine, but we've got to do the whole calculation for cost of sales, and remember that this is your opening position, okay, plus purchases minus your closing. Okay, so we need to do each of those. So we can see our opening is 36,325. Okay, and plus our purchases, which is this one, 348,973. 348,973, and then we've got our closing, which is 49,105. Okay, so like we're doing a fair bit of legwork here in terms of actually getting the answer together here, but we are getting there. Okay, so now we can actually establish what our cost of sales position is, and overall that figure is 336,193. Okay, 336,193. Okay, when we go through opening plus purchases minus the closing. Okay, so now we've got to do 42,715 divided by this. Okay, times 365. And when we run through that, what answer do we get? Well, we get what, 46.3. Yeah. Okay, so we can put down 46.3 days. Okay. All right. So there it is. Right, let's take a look at what we've got here. So Connor is concerned with the decline of his inventory turnover. Okay, so we can see that basically he's just getting his stock turned over every 46.3 days. Now, why is this likely to be a problem? Okay, well, because the nature of the good is one that's perishable. Okay, so we know his inventory turnover is 46.3 days. So like, we don't want his stock just like sitting on the side just going moldy or whatever it's doing. Okay, so really we've then got to think, right, how can he improve the inventory turnover? Assess whether reducing his prices can help improve the inventory turnover. Right, well, first up, it could stimulate demand, couldn't it? Okay, so it could actually increase demand, and that's obviously going to be a really important point. Now, this may mean that he can attract more customers. Okay, so that would work. Now, he might also notice that a particular product that he sells has the highest sort of or the poorest inventory turnover, and so, or maybe one particular product goes off quicker than the others. So he could use this with a slow selling product. Okay. Rather than necessarily reducing his prices right across the board, okay, because you don't really want to do that. Okay, now alternatively, it could be a product which goes off quickly, something along those lines. All right. Okay. Yeah, and then he might be able to target a new market, target a different market segment, okay, because now he's actually saying, right, okay, well, I'm not selling all my cheeses as quickly as I want to, so what I need to do is reduce the price of one particular one, and maybe he offers that to customers who didn't generally buy his cheeses. Okay, all right, now the downside, right, well, he's going to reduced contribution per unit. That's not going to be great news. Okay, so reduced contribution per unit. Okay, now if the contribution per unit goes down, then break-even point may rise. Okay, will rise. So that's not great. What else does that mean? Well, that means the margin of safety will decrease. Okay, so the margin of safety will decrease now. And there's also the point, we don't know whether this will actually help. Will people simply eat more cheese because the price has fallen? Okay, so will demand actually increase? All right, and that all works very nicely. And then you could also put down about how, like, his gross profit would be reduced, his gross profit margin, etc. Okay, that would all work. Okay, lovely job. Right, so let's move it on now. We've got a bit of cash flow beauty here. Okay, so let's run through these nice and quickly then. So when it comes to our first one here, we've got the credit sales, but we then have this total income. So how do we work out what this cash sales amount actually was? Well, we've just got to go 67,278 minus this one, and that will give us our answer, which is what, 38,926. Okay, then number two, we've got our expenditures. Now we just need to total up all of those, add up all of those. And when we add up all of those, we can see that we end up with what, 431, 223. Okay, so we've now got income of this, expenditure of this, and this nasty net cash flow position down here. Okay, really nasty looking. Now we then end up with 353,954 negative. Now he's clearly started in a positive position, so all we need to do is, if we consider this as a positive at the moment and just add that back on, because it's been subtracted to get this minus, then it will tell us what the opening balance actually was. So if we add 363,945 onto that, it will tell us that our opening balance was actually 10 grand. Okay, fine. Now let's move it through to number 4 here. Okay, so we've got to do net cash flow. So that's our income minus our expenditure. Okay, so the income minus our expenditure, 148,298 minus this one, and that then leads through to what, 60,957. All right, 60,957. Okay, lovely. Now, where are we next? Where's number 5 here? Okay, so then we've got to work out our total income, and we can see we've got to add up all of these. Now, a loan isn't revenue, but it does provide that cash inflow, doesn't it? Okay, so as we add that one on there, then we put in 364,086. Right, lovely. And then we've got to work out our opening balance. Well, we know the opening balance is going to be that one, so the answer is pretty much already in there for us. So it's going to be 292,988. Okay, and we're done. But of course, I've got to put that in brackets, okay, because it's negative. Okay, so make sure we don't make that mistake. All right, so if it is negative, it's got to be in brackets. All right, lovely stuff. Now, what do we got next? Well, as part of the classic cheese expansion plan, Connor intends to purchase some non-current assets in January. He will take out a loan in March. Well, we've just seen that loan come through, haven't we? Okay, so that's that loan of 280. I'm just going to make a note here, 280 grand coming in. Buying. So Connie usually bulk buys his raw materials to earn a discount. Many of his customers are supermarkets who insist on extended credit periods before they pay. Classic cheese, and we've seen that with his high inventory turnover, haven't we? Connor is concerned with the liquidity of the business over forthcoming months based on the projections in 11C. His bank manager has advised him that the overdraft will not be allowed to exceed 100 grand at any time. So look at this, right, we've seen that this month is a problem, and then it sorts itself out. So he almost needs to get that loan in earlier. If he gets that loan in earlier, that could really help. But evaluate potential solutions to help improve the liquidity of classic cheese. Okay, right. Now, fine. So, yeah, I mean, he has got to make sure that he arranges this overdraft, because as things stand, he will exceed his agreed overdraft. Okay, now with this question, I didn't say we're looking at PPJ, of course. Okay, paragraph 1, paragraph 2, and a judgment here. Okay, so we've got to provide a decent judgment. Answer the question. It depends upon, most importantly. Okay, those are the elements to really answering these questions well. He will exceed his agreed overdraft OD. Okay, all right. Now this would result in, like, I'm starting on the negative here, but that's okay. This would result in additional fees, and he may actually face problems paying his suppliers and so on. Okay, so yeah, not great news. Now, what else does he also have as problem? Well, his if we come back to this, okay, and we want to use some application here, okay, because we could actually specify the amount, and we could say, look, you know, he needs 353,945. He needs, like, there are 2 really nasty months in January and February, so use that information in your answer, okay. Now, we've also got a huge number of credit sales, particularly in February. Now, this is not good, so we need to sort that one out as well. So we've already seen that Connor's, okay, so Connor's, that's got two ends, but don't worry. Connor's inventory turnover is high. Okay, inventory turnover is high. What was it? 40 something days, wasn't it? Okay, 46 days. Okay, 46.3 days or so. And he has a lot of credit sales in February. And again, we can specify that amount. Okay, so use the exact amount here, 102,516. All right, lovely. Now, what else do we know? Well, liquidity is going to be made worse by those credit sales. Okay, so this will cause additional liquidity problems. Oh, I'm just giving him problems at the moment, not solutions. Okay, this will give him additional liquidity problems. Okay, but that's all right as long as I, in my second paragraph, go in to look at what we can actually do about this. Okay, so okay, fine. Now that's my first paragraph taken care of. What could we do instead? Well, instead of worrying about sort of borrowing that money and you know, why is he borrowing it so late? Because he's buying it here in January, and then he's borrowing the money there. Like, this is like, this is really not good stuff, is it? Okay, so what could he do instead? Well, he could think about actually leasing this equipment. Okay, so a lease or hire purchase agreement, a lease or HP agreement, may write in full sentences. I'm only doing this because I'm doing this quickly, just on the video here. Okay, so do put down what you mean by HP. Okay, a lease or HP agreement will help to reduce his expenditure dramatically, and we can refer to January there, in Jan. Okay, and that may enable him to actually ensure that he doesn't go anywhere near as like badly as this, and he stays within that £100,000 limit then. Okay, now fine. Right, what else have we got? Now we could also think about what he could do with his credit purchases. So he's taking on some credit here. I don't know what sort of credit period he's got there. Okay, so can he negotiate a credit period of say 60 days? If he can, then that would help to improve things as well. So that's something else I'd focus on reaching a judgment on as well. Right, so yes, he can certainly think about making sure that he gets that loan in time, and that would certainly help. He can think about making sure that his trade credit is as long as possible as well. That would also very much help this situation. Now, finally, what would we finish off with? Well, I'd certainly suggest that he makes sure that he gets the loan in advance of buying the non-current asset. Loan before non-current asset, like, that's got to be absolutely fundamental. Okay, so that's got to be the way he's got to go there. I don't know whether it's highly specialist and whether he really needs this or whether he could just borrow it. So there we go, guys. That is the end of the exam. So we can see, you know, there's some big differences here, and I would really suggest that you focus on trying to develop as many paragraphs as you can. I mean, I've recommended 2 paragraphs and a judgment here, but I would try and break into 3 paragraphs if you possibly can. This is quite a meaty question and really requires you to go back through this information, but use all of this prior information that we've actually worked through here to develop your answer really fully, and you can then bring in your knowledge from other areas. So, you know, is it possible that you could get a loan from elsewhere or something along those lines? Okay, but there it is. Okay, it's a lot shorter than the previous paper, so 20 marks have been shaved out of this. Now, that means time-wise, there isn't the same time issue that candidates have previously had. So we can see that 80 marks here rather than 100 marks. So, you need to spend a lot of time going through these questions in as much detail as you can, and make sure you go back and use these numbers productively in your answers. Great stuff. I hope this has been useful. See you soon.